You check your bank account and something's wrong. Your mortgage payment, the one that's supposed to be the same every month, just jumped by $300. No letter, no warning, no explanation. And when you call your lender, they act like this is completely normal. If this just happened to you, you're not alone. Thousands of homeowners are getting hit with surprise mortgage increases, and most have no idea why. Your mortgage payment is supposed to be predictable. That's the whole point of a fixed rate mortgage, right? You lock in a rate, you know exactly what you'll pay every month for the next 15 or 30 years, financial stability, peace of mind, except that's not the whole story because your mortgage payment isn't just principal and interest. And the parts that aren't locked in, they can change, sometimes dramatically, and often without the kind of advance notice you'd expect for something that impacts your biggest monthly expense. Let's start with the biggest culprit, escrow accounts. When most people get a mortgage, their lender sets up an escrow account. This is a separate account where you pay a little extra each month to cover property taxes and homeowners insurance. Then, when those bills come due, the lender pays them on your behalf from the escrow account. In theory, this is helpful. You don't have to worry about coming up with thousands of dollars twice a year for property taxes. It's built into your monthly payment. But here's the problem. Property taxes and insurance premiums don't stay the same. They go up, sometimes a lot. And when they do, your escrow payment goes up, which means your total mortgage payment goes up. Let me give you a real example. Say your mortgage is $2,000 a month. That breaks down to maybe $1,400 in principal and interest, the fixed part, $400 for property taxes, and $200 for insurance, the escrow part. Your monthly escrow payment is $600. Now your property value gets reassessed and your property taxes jump 20%, and it can happen in a single year. Why it feels like no warning. Now, technically, lenders are required to give you notice when your escrow payment changes. They have to send you an annual escrow analysis statement. But here's the thing, most people don't read it carefully or they don't understand what it means. The notice might come 30 to 45 days before the change takes effect. It's usually a dense multi-page document filled with numbers and projections. It doesn't scream, your payment is about to jump $200 a month. It's easy to miss or misunderstand, and sometimes the increases happen faster than the normal annual analysis cycle. If your insurance company cancels your policy mid-year and you have to get new, more expensive coverage, your lender will adjust your escrow immediately. The insurance crisis. One of the biggest drivers of unexpected mortgage increases right now is homeowners insurance, and it's getting worse. Insurance companies are pulling out of high-risk states entirely. Florida, California, Louisiana, they're all facing insurance crises. Companies are either leaving or raising rates by 30%, 40%, even 50% in a single year. Why? Climate-related disasters, more hurricanes, more wildfires, more flooding. Insurance companies are paying out more in claims than they're collecting in premiums, so they're either leaving or jacking up rates to stay profitable. If you live in one of these states, your insurance premium might have doubled in the last 2 years, and that's not your lender's fault, but it still shows up as a higher mortgage payment. The property tax surprise. Property taxes are the other major factor, and they're hitting people in unexpected ways. In hot housing markets, property values have skyrocketed. If you bought your house 3 years ago for $300,000 and it's now worth $450,000, your property taxes are based on that new higher value. Depending on your local tax rate, that could mean an extra $1,500 to $3,000 per year in property taxes. Here's a scenario that's catching a lot of people off guard. You buy a house, and for the first year, your property taxes are based on the previous owner's assessment. Then in year 2, the county reassesses based on your purchase price, and your taxes jump significantly. Your lender tries to anticipate this in your escrow account, but they don't always get it right. When the actual tax bill comes in higher than what was escrowed, you now have an escrow shortage. The escrow shortage spiral. Here's where it gets really painful. When your escrow account runs short, meaning the lender had to pay more for taxes and insurance than what you had in the account, you owe that money back. Let's say you had an escrow shortage of $1,200, the lender might give you the option to pay it all at once. But if you can't or don't, they spread it over the next 12 months. That's an extra $100 a month. But that's not all. They also have to increase your regular escrow payment to cover the new higher taxes and insurance going forward. So you're paying catch up plus the new higher amount. What you can do about it. Okay, so what can you actually do if this is happening to you? First, understand your escrow statement. When that annual analysis arrives, actually read it. Look at what they're projecting for property taxes and insurance. If the numbers seem wrong, call them immediately. Second, shop your homeowners insurance every year. Don't just accept the renewal. Get quotes from multiple companies. You might find coverage that's hundreds or even thousands cheaper. If you do switch, notify your lender immediately so they can update your escrow. Third, appeal your property tax assessment. If your property value assessment seems too high, you have the right to appeal. The process varies by county, but it's often simpler than people think. If you win, your taxes go down, which lowers your mortgage payment. Fourth, consider paying taxes and insurance yourself. If you have enough equity, some lenders will let you close your escrow account and pay these bills directly. This doesn't make the costs go away, but it gives you more control and eliminates surprise escrow adjustments. Just make sure you have the discipline to save for these big bills. Fifth, build a buffer. If you can swing it, keep an extra $1,000 to $2,000 in savings specifically for housing costs. That way, if your payment does jump unexpectedly, you're not immediately in crisis mode. Here's the uncomfortable truth. The days of predictable, stable housing costs are over for many Americans. Between climate change driving insurance costs, housing shortages driving property values and taxes and general inflation, the cost of homeownership is becoming more volatile. This isn't your lender trying to screw you over. In most cases, they're just the messenger. The real issues are systemic: insurance markets in crisis, property tax systems that can't keep up with rapidly changing home values, and inadequate communication about how escrow accounts actually work. The system was designed in an era when housing costs were relatively stable. A 3 to 5% annual increase was normal and manageable. But when insurance jumps 40% in 1 year or property taxes spike 25%, the system breaks down, and homeowners are the ones who suffer. If your mortgage payment just jumped without warning, you're not crazy and you're not alone. It's happening to millions of homeowners across the country. The key is to stay informed, review your escrow statements carefully, shop around for better insurance rates, and appeal unfair property tax assessments. You have more control over this than you think. And if you're in the market to buy a house, factor this into your planning. Don't just budget for the mortgage payment. Budget for the mortgage payment plus 10 to 15% extra, because that payment is likely going up. The dream of a fixed, predictable housing payment is increasingly a myth. But if you understand how escrow works and stay on top of your taxes and insurance, you can at least avoid the nasty surprises. Have you experienced an unexpected mortgage increase? Drop your story in the comments. And if this video helped you understand what's happening, hit that like button and subscribe for more real talk about personal finance. Thanks for watching, and good luck out there.